Market Hustle community, welcome to episode 71. For those of you who are new here, my name is Josh. Welcome to the podcast. I'm the guy behind the Market Hustle. And for those of you who are returning, welcome back to another great episode. Today, we've got the co-host here. We have Pierce and Baafi with us today, and we're going to dive into kind of what's going on in the markets. It's roughly 2 months into 2026 now. So we're going to tackle kind of what's kind of shifting, what we're kind of noticing, as well as just give you kind of an update on our lives and kind of what we've been up to and whatnot. It's been a little bit since we've kind of dived into, what Baafi's up to, what Pierce is up to, what myself is up to. So we'll do a little bit of a life update, if you will. And then after that, we're probably going to dive into, more of the emerging market side of things. I know there's been a lot of questions around, investing outside the US. A lot of people know that we, especially me and Baafi, are more heavily invested in the US. But we're going to tackle more of options outside, such as emerging market funds like VWO. So it's great to have everybody back here. This is going to be a fun episode. Make sure to take some notes. So before we actually officially jump into the topics, let's welcome back the lovely co-host. Let's first hop over to Baafi. Baafi's in New Jersey. How are you doing, my friends?
Man, I'm doing better than good. It's good to be back on. I know it's been a little bit since I hopped on one of these episodes. Been quite a busy 2 weeks as I started my new role in our pension and benefits investment team in Treasury. And obviously, as you can imagine, it's surrounding all the subject matters that we discuss here on the podcast. And I'll share as much as I can where I will not get fired because I did have to sign a bunch of NDAs and very high sensitive confidential documentation and stuff to make sure that I'm not breaking any rules or laws. So if I'm a little bit limited in how much I say, that's the reason why in terms of my online presence. But it's been a great journey, learning a ton, being able to work at the front end of everything that's happening right now in the market, in the economy, both domestic and globally, has been exciting. So really enjoying that journey and looking to share as much as I can. Life's been good. Other than that, personal life is great. Can't complain. We've been getting a lot of snow up here in New Jersey. So hopefully this is the last big one, and we can look to brighter days and greener grass. So we'll see. But yeah, let's go. It's been fun.
Yeah, well, hey, congratulations on the new role, man. It sounds like a perfect fit based on where your skill set is. What's been kind of, I'm curious, like what's been the most surprising thing you've kind of noticed or learned so far? Of course, what you can
Yeah, I
share.
think ooh, that's great. I think one of the most surprising things is the exposure to all the major firms and the access to information that I have that the average individual, like a newer investor or even just a seasoned investor, just won't have access to, right? So I have access to back end information, whether you think of all the major firms or brokerages that you can imagine. I have portal and client access to, very high level research tools that almost nobody, very, very few people get information like that. So that's been interesting. And I think one thing to really harp on briefly is the fact that whatever the average investor, of course, there are people out there that trade for a living, and that's all good and dandy. And I hope they've been doing well, given a lot of the market volatility that we've seen recently. I hope everybody's doing all right in the trading space. But what I will say is that, and there's an analogy that's going to put everything in perspective. And that is, imagine trying to go from here to China, right? China being, a bunch of gains in the market, right? Financial freedom, just like 10xing your money, diamond hands, whatever you want to call it. And you, the average investor, is walking, right, from here to China. What I would say is that these institutions and the amount of money and resources they manage and invest for, big Fortune 100, Fortune 500 companies, you got to picture those fund managers as flying F-22 fighter jets to China, right? So you're not going to beat them because they have information and tools before anybody else does, or before it even hits CNBC, before it hits YouTube, before it hits social media. So by the time you get the information, they have already maximized the opportunity and they're gone, right? So, and that's the space that you got to understand. Some of these fund managers have been doing it for 20, 30 years. They have a whole team behind them. Meanwhile, it's just you looking at one stock or looking at one company trying to figure out what is the needle in the haystack when these guys have a whole team that work on this thing daily, 24/7 all over the world. So, Bottom line is they all compare their performances against the benchmarks, and some of them, of course, outperform the benchmark mark by a large margin, and some of them don't outperform given the nature or the season that the cycle is in, right? And so, truthfully, a lot of the things we preach on this podcast is exactly what you should be doing because if you've seen what I've seen and you know what I know, you will realize that your best strategy is to buy index funds, ETFs, hold for long term, consistently buy, and do absolutely nothing because you are not beating these folks. So days like now, like today, when you see sell off in the market or you see certain shifts with money moving around, you might shift around a couple thousands, maybe 10,000, 20,000, 50K. If these guys are moving hundreds of millions and billions, it's a different ball game. So you see Nvidia go up, earnings was great, things were great, Nvidia go up, and you see a pretty decent sell off. Most of that sell off is not your regular folks selling off. It's these guys that have a ton of money, billions and billions, billions of dollars worth of stocks in those companies, made a really sizable jump, and they're just taking some of the profit off to rebalance their asset allocation and their sector allocation, right? So that's a game you're just not gonna win because that's the house do and the house has all the cards. That's for sure.
Hey, you heard it from somebody who's kind of seen in the inside himself. So take some notes. I mean, Baafi, like that's exactly what we've been preaching for years on this podcast is your edge, especially as an investor who doesn't have access to billions of dollars worth of tools and research that these guys maybe are, using and have access to. Your edge is going to come from long-term ownership. Like the more quality assets that you stack and the longer you can actually hold those assets and let them grow, let them do their thing, like that's where your main edge is going to come into play in the stock market. And Baafi is giving you an inside glimpse to kind of what's going on. And I have a question, Baafi, as well.
Hmm.
I want to run with this a little bit longer because
Yeah, man, let's do it.
yeah, I'm fascinated. Really, the first question is like, so like you see the reaction maybe on social media when we see these like micro moves day to day, right? Where like
Hmm.
Nvidia did sell off, 5%, and then like everybody wants a reason, right? Like everybody wants some
Right.
like story behind like why did it happen?
Yeah.
Like, what's the reason? Did Nvidia say something wrong?
Uh-huh.
But you touched on something important. It's like, these fund managers who are managing billions of dollars, like maybe they just had to make a quick sale for whatever reason that, you
Yeah.
you might not ever know. It's like I'm curious, like what's your thoughts like as you're seeing and learning more behind the scenes with how these institutions are moving money? Like what would you
Right.
tell somebody who kind of gets caught up in like the short-term stories or trying to
Yeah.
figure it out
So
and piece the
I would
pieces of
tell
the
you,
puzzle together?
I'm not gonna lie. I'll tell you sometimes there's no rhyme or reason. And sometimes it has nothing to do with the company's earnings or they said something wrong or they're not innovative, right? Or sometimes it also has nothing to do with geopolitical tension, rates, all these other things, or AI. Sometimes the company has been, like let's say sometimes the firm have been invested in the said company or said sector for many years and it has grown to be an overweight in their portfolio, right? In their strategy and asset allocation. So what they will do often is they will sell that overweight to bring it back in balance with the strategy. So in turn that reduces the risk, right? Sometimes they will sell because, geopolitical tension, maybe certain sectors and industries or companies are more influenced or heavily impacted by policies, whether for good reason or bad reasons, whether rates up or down, whether we see a shift in infrastructure and build out, whether it's materials, special metals, whatever the reasons are, is always a combination of a bunch of things or things that they are seeing in those markets and sectors. And so they are essentially pivoting or getting ahead of the flood, right? So they will sell before you sell. They will buy before you buy, So there's a lot of reasons why sometimes they sell and sometimes they might sell because maybe their client is like, hey, I want to sell because I need the money for a different opportunity, right, or a different thing that they're doing. So you never really know why somebody's selling unless you're the one selling. Only you know, right? Because you know why you're selling, and whoever's buying have their own speculations or valuation as to why they are buying. So yeah, it's pretty much a combination of a bunch of things. And sometimes I've realized sometimes it's not even about reading too hard into it. The sell has nothing to do with market conditions or AI or competition. Sometimes they're just selling to get back to better asset allocation based on the strategy and mandate that they have for themselves.
Interesting. Yeah, that makes sense. I mean, maybe their goals shift or they got something
Exactly.
happening,
Yeah.
some
Or
things in the
like
background.
or they see some changes in the fundamentals of a
Yeah.
specific sector or the specific stock, right? Then they'll get rid of it because maybe the balance sheet is not as strong. The valuations are overinflated, right? Or might sell that, buy something else because they see, oh, there's a nice little pivot or cash moving around from one sector to this specific sector. And in that sector that the money's going to, this specific stock has been undervalued for quite some time, but there's some changes coming up, right? That is going to allow that company to essentially improve the business, improve the balance sheet, more capital expenditure, and scale the business. And so that maybe they see certain lucrative opportunities that the average person simply just won't see, right? The average person would just see whatever CNBC says or what hits threads or Instagram or TikTok or and YouTube. But at that point, it's too late. Like the information you get very surface level information from the outside.
Interesting, interesting. Yeah, I think it's fascinating because again, it's nothing we don't preach on this podcast, but it's really nice to see kind of your thoughts on what you're scoping out, Baafi, now that you're kind of getting kind of a look under the hood, now that
Oh
you're seeing
yeah,
how these hedge funds kind of move and you're seeing the
it's
data and the
incredible,
tools that they
man.
have access to.
Yeah, it's
And I think
incredible.
what's important is like, one hedge fund who manages billions of dollars, they might have a benchmark or goals kind of set, and then they might sell for a
Yep.
certain reason. But like you got to remember, there's hundreds, if not thousands, of different hedge fund managers and just fund
Yeah.
managers themselves that all have different goals.
Completely different goals, and the strategies are all different, right? Like
Yeah.
some might be in small cap, some might be in value, some might be in mid cap, large cap, some might have a combination of small cap and mid cap, right? Some might only invest in companies and markets outside of the US. Some might only do US specifically, and then you also have some of your fixed income, meaning your money market bonds, right? Corporate bonds, treasuries, and those are all investment strategies that are available, and so they all have different makeup and different strategies that they go about, and some of them lean more into the momentum, right, and the tech slash advancement and that productivity stage that we see things moving into. Some of them are a little bit more fundamentalist, or they stick to a certain core value principles, which, of course, if over the last 5 years, right, the growth narrative has been the most attractive thing. And so if you're more on a fundamental slash value based, you might have not seen much, but guess what? In Q1 so far, especially in January, you definitely see that strategy get rewarded. It flips, right? Because
Yeah.
you saw the sell off, whether it's with gold, silver, Bitcoin, and then more into your broader businesses, your software stocks, tech stocks, and just across the board. So different strategies work in different seasons. And that's why it's really difficult as a retail investor or average person to be like, oh, in this season, this is the perfect strategy. And then when that strategy is going into another season, your ability to pivot and get ahead of it is impossible. It's impossible. So yeah, it's really interesting to see just all the, like, I would say all the perspectives or all the things that play, right? Because everybody's searching for alpha, aka better returns than the benchmark. And it's very, very difficult, even for these hedge funds and people that are managing billions and billions of dollars for clients. That's very difficult. Like you need a whole army to succeed in that. Literally, it's insane.
Yeah, and the good news to anybody listening is you don't need to sit here and try to be like these fund managers. It's like, again, your edge is going to come from the long-term ownership in the broader funds that
Yep.
don't require you to time the seasons or to
Yeah.
predict what's going to happen next, right?
Agreed.
To Bafi's point, I mean, of course, there are fund managers that do exceptionally well and outperform, and they are highly skilled. But even for these fund managers, like the data is pretty clear. It's like a majority of them don't do well, and they still underperform despite all of the tools and information they have access to. So something to kind of to keep in mind, like as you're going through your journey. And Bafi, I'm very grateful that you're willing to come on the podcast and
Of
share some
course,
of
man.
the
Look,
things
it's
you're learning.
nice. It's nice, bro. I wish everybody on the podcast and that listens to the podcast could be like a fly on the wall in some of the meetings and our fund manager meetings that we're having, because it's such a wealth of knowledge that you can only learn so much by yourself. But it's like when you have this type of aperture and scope to people that have been in the business for 20, 30 years, and they have boots on the ground, they have ears and eyes everywhere,
Yeah.
they have tools and data that they are pulling from all these markets, and is running through a bunch of models that helps them identify quality businesses. you can't compete with that. There's just no other way to do that, you know.
Hmm. Makes sense. Makes sense. Well, let's get Pierce onto here. Let's pivot over to Pierce,
Yeah.
see how he's doing, and then we can probably unpack it a little bit more. Maybe Pierce has some questions. But Pierce, you're in Southern California. I know
I
it's
am
nice over there. You got what is it, like 70 degrees?
70 degrees at 6:42 p.m.
Oof, I'm
Well,
jealous.
yeah, same here. It's been a little bit rainy and cold in the Pacific Northwest. But great to have you back in here, Pierce. How are things been on your end, man?
Things are good. Recently, just got a new job. Can't disclose technically what I'm doing yet because, kind of what Baafi's doing. But it's, I'm excited for the new venture in life and the new step in the right direction. Other than that, man, I've been unemployed in a sense for the last 2 weeks. I've been doing my studying and all this type of stuff, paperwork, whatever. And it's been phenomenal. And I just want everyone to know that, it's great not working right now. I just want to make that very known. It's awesome. I get to wake up when I want and do all this type of stuff. But another piece of that is I don't have to stress about money right now, and that's because of kind of all the like we go back to it, the fundamentals of what we've been teaching over the last couple of years in the podcast is I have my emergency fund set. I have money set aside for rainy days, and I guess this could be a rainy 2 weeks or whatever you want to call it. But it's awesome because I don't have to stress about it. But I'm excited to be back on the podcast. There's a lot to digest with this one. I think we're all decently we have a little bit of knowledge about this, so I'm excited to see everyone's point of view.
Awesome, man. Well, congrats on the new job, and yeah, you're in
Appreciate
the
it.
middle of that transition,
Yes,
which
sir.
it can be a little choppy. And the good news is because you practice what we preach, constantly on this podcast, like you've built a foundation that is that's kind of easing your way over to this new career transition. And yeah, I know you have some, it's in the financial industry, but yeah, we got to be
Yep.
careful compliance wise. But it's good
Yeah.
to have you back, man. And I'm excited,
Thank
for
you.
you, like this is going to be a much better job, hop, and you're going to learn, I'm sure, a
Yeah.
lot,
Yeah,
especially
I'm
with the
excited.
license you're getting. So yeah, big congrats to you, man.
Thank you so much.
But nonetheless, let's jump into this. Let's start, with the general market dynamics. So, we've officially kicked off 2026, and there's been a lot of moving parts, right? At the time of this recording, it's currently the end of February, and the S&P 500 is currently up about 1%. So, despite some of the riskier asset sell-offs that we've seen, such as the crypto world's taken a massive hit with Bitcoin down nearly 50%. And a lot of tech stocks have also been getting pretty hammered in 2026. The Mag 7, for example, some of these big tech stocks, the Nvidia, Microsoft, Google, Apple, like some of the top heavy portions of even the S&P 500 have been getting a little, little smacked, a little corrected. There's been a correction in some of these stocks. Microsoft's down over 15% at the time of this recording. So like these stocks are taking a little bit of a hit. But despite that, what's interesting is that the S&P 500 is still up nearly 1%. And what I see in that is that some of the smaller large companies are kind of doing a little bit more of the heavy lifting. But I'm curious to kind of see what you guys, Pierce and Baafi especially. I know he's I know he can't say a lot of stuff, but like maybe Baafi has some insights of like what he's noticing in the market, the broader market
Yeah.
specifically.
No, absolutely, man. I think one thing that investors, I believe, have learned in the short term recently is that most investors and even most countries and nations, they have a very high weighted exposure to the US market, right? In terms of from like an investment perspective. And I think 2025 pretty much taught everybody that, hey, we need to kind of keep our eye out in terms of, hey, there's other markets, there's a lot of other opportunities everywhere, right? Not just the US market alone. And then given some of the administration decisions and policies and the challenges related to that and relationships across borders and stuff like that, that makes it a little bit of an uncertainty ground, right? And so, right now, in terms of insight, people are learning that, hey, it's good to have exposure to international stocks, right? I mean, we saw how Japan performed incredibly well, rebounding back from like a 30-year basically recovery process to the point where now they actually have to raise rates. And that's actually really a healthy sign for them, And I would say in terms of outside of US, in terms of in emerging markets, equities delivered really strong growth and capital inflows to really kick off this year. And that kind of reverses that overweight in the US market and shifted more funds So there's a lot of inflows going into international markets, right? And it has broadened quite well. So you talk about Asia in terms of tech exporters, right? Example, semiconductors, which everybody's very familiar with. You talk about data centers, just the build out, the manufacturing of the chips themselves and all these things, commodities, right? Brazil, Peru did really well. So cyclical growth market there. And you're going to continue to see that as rates come down globally, as the financial systems and the banks around the world, central banks around the world, keep rates down, and that essentially stimulates more economic activity, more growth. It becomes a risk-on situation, especially for international markets all over the world. So there's a lot of opportunity, but by the same token, it doesn't mean that the U.S. market is a sleeper. Despite all the administration and the different things happening all over the world, that just brings a ton of uncertainty to the market. Like Josh said, it's still up 1%. So essentially, all the gains from 2025 is still in it. You know what I mean? It's like nobody's lost anything really, if you think about it, unless you had software stocks this year, early this year, then you might be cooked a little bit. But yeah, that's on a high level. I think that's kind of the theme that everybody's seeing. It's like, hey, there's opportunities, not just in the U.S. It's good to diversify broadly,
Mhm.
and benefit from some of the economic shifts that we're seeing in recent history.
All right, good points. And I think what it really shows as well is like just the cyclical nature of markets, right? Like, of course, certain parts of the market might do really well. Like tech has done exceptionally well over the last decade, but that doesn't mean that, sometimes investors have a habit of, just watching what's kind of the shiny object, if you will, and kind of only focusing on that certain asset. And then maybe they write off, like, oh, the Japanese stock market, like, oh, that's been in a 30-year bear market, it's never coming back. And then markets have a funny way of kind of surprising you in the future. And like what we've seen in the Japanese market, especially, is that it's actually outperformed the U.S. market over the last couple of years, and it's out of its 30-year bear markets, which was it's absolutely insane. And so like it's kind of I think that alone is kind of like something that a lot of investors are starting to digest and be like, you know what, maybe there are other opportunities out there rather than just tech specifically. And the good news is there is, and we're going to talk about emerging markets and whatnot. And I will say, and maybe Baafi or Pierce, you guys can speak to this as well. Is emerging markets, although they've had a track record where they've been pretty choppy. They haven't really done too well over a 10-year time frame, but over the last couple of years, they've actually been kind of outperforming the broader S&P 500 markets. And in the way I view them specifically is like I see emerging markets as just a different growth strategy, right? Because like these are companies you got to keep in mind inside economies that are still kind of developing, right? For example, we're going to talk about VWO, which is Vanguard's emerging market fund, a little bit later, but that fund specifically gives you exposure to China, Taiwan, India, Brazil. So like some of these countries that are still, developing their economies as a whole. It's like when you buy a fund like VWO, it's like you're getting exposure to the companies that are within those economies that are growing rapidly, so they can kind of ideally ride that tailwind if those economies start chugging along and doing well. That being said, like any strategy that's more aggressive or growth oriented, there's still risks to it, and there's more volatility. To where those economies, when they're rapidly growing, they tend to have kind of sharp pullbacks. Typically, what we see with any aggressive asset, I mean, look at Bitcoin and crypto. It's like they do really well on the way up, but they can also kind of snap back and kind of have a little choppiness to them as well when those markets kind of flip or they go through their cycle. So I'm curious to kind of see, maybe Baafi or Pierce, if you guys want to talk to what you notice in these market cycles, or even how you view, emerging markets specifically.
Yeah, I think, for me, um, this year so far has been really good. Given my current role, I've been exposed to emerging markets quite a bit, and then also in reviewing, a lot of the investments and things of that nature. I've been able to kind of understand that area a bit more. And so everything I'm going to say right now has nothing to do with my actual work, right? I just want to make that disclaimer. I'm not taking like company and business trade secrets and then bringing it here to the podcast. This is all public knowledge
As
in
much as
terms
we'd
of
want it,
as right. But I would say I like to touch on the market and the economy pieces of it, and then I'll let Pierce touch more on kind of bringing it full circle into the fund that kind of gives you that broad exposure, the breadth of it, and probably perhaps why he likes those type of emerging market funds. So what I would say is for 2026 specifically in terms of like a roadmap, like there are a lot of bullish factors, but also risk to the entire space, right? So bullish factor wise, I would say broader global investor interest and valuation favors these type of assets right now in markets. Taking AI hardware demand structurally and the benefits of that is huge for supply chain there, right? And then one thing people tend to forget is that softer dollar makes it very supportive for improving financial conditions outside of US, right? So the softer the US dollar goes or the more it devalues, it actually does the opposite for other countries and their markets and their businesses and their financial institutions from a credit backing and investments and activities flow there, right? Now, the risk to the counterpart of that is geopolitical and tariff volatility. Right now, that is definitely we've been in the tariff space for a year or two right now, and just kind of dealing with all of it, and we've
Mm.
kind of gotten used to it a little bit, right? But there's still companies are still cautious in how they make decisions or how much they really push the limit of growth because at any given moment, Big T can change his mind, and all of a sudden now they got to scramble and figure some stuff out, right? Also, one thing I want to keep in mind is when it comes to emerging markets, the growth is variably like is variability across regions and countries. So it varies, right? It's impossible to say like, okay, every emerging market or every emerging market country based is performing really well and is going to give you incredible returns. You know what I mean? So, and that's where, when Pierce starts to speak on it, that's where having a fund that kind of gives you a good balance across is really healthy. So in terms of emerging markets, I would say, well, China's not emerging. It's pretty much I'll put it this way. For Asia, right, some of the largest and most influential im things to emerging market is really China's important because AI hardware, EV supply chain, industrial automation, property stabilization, exports, right? Despite all those tensions, at the end of the day, in Asia, China is like the US of the West. You know what I mean? So, yeah, China's not an emerging market. It's a huge market, but it does have influence and impact on the neighboring countries in that Asia region, right? The APAC region. The biggest risk with China is just that the policies are unpredictable, and there's a lot of
Yeah.
trade friction right now, because in China it's more like the state owns everything. The state owns the huge pieces of the banks, huge real estate, huge everything. And so it's a little bit tricky the way that is set up. But Taiwan is a very exciting place, obviously, given the data centers and AI and the infrastructure build out along with the chips. South Korea is interesting. Vietnam is interesting. Indonesia. You got to keep in mind some of these APAC countries or areas there is the hardware that's needed, right? They have a lot of hardware capabilities. Latin America is interesting too because you got commodities, so if you look at Brazil, you think in agriculture, iron ore, energy, that's hugely beneficial. If you think about Mexico, manufacturing shifts from Asia to North America, right? Given the trade tensions and friction there a little bit, industrial real estate boom, auto production growth. Peru is an interesting place. You talk about copper, that's a huge place for like critical minerals for electrification and grid expansion, which is all going to be needed as we move forward, and then shifting a little bit to the EMEA region, if you think about energy plus reform stories, so Saudi Arabia, right? They got mega projects, tourism, logistics, financial markets are developing nice. Oil, of course, that's like the headquarters of oil on the planet. You talk about UAE, United Arab Emirates, the capital inflows, AI infrastructure, real estate and tourism. South Africa too is huge in terms of commodity and structural reform. So you got platinum group metals, power grid stabilization efforts there. Poland is another area that's really interesting. So there's a lot of opportunity in this space in a lot of different markets. The challenge is plenty of options is great, but how do you know which one and what ratio and what balance is perfect for you to get the gains that you want to get? Assuming as much information as you can put together and make an informed decision on. There's also the other side of variable information that nobody has the information and can't make decisions based on because they're all uncertainty stuff, And
Yeah.
so that's as deep as I want to dive into it, and then we kind of let's
That was
bring it
deep.
back full circle a
That
little
was
bit
pretty
with
deep. I
Pierce.
love
Yeah.
it.
Yep.
Now, I do want to just quickly touch on, just so there's no confusion,
Hmm.
the difference between emerging markets and developed markets, right? Because if somebody's listening to this for the first time, they might be like, okay, what's the difference between something that's emerging market compared to like the US, right? Like everybody's familiar with the US stock markets, mostly because it's the biggest stock market in the world. It has the most capital investments out of any country by a wide margin. China's number two. But nonetheless, I just want to quickly touch on the difference between what's called, an emerging market country
Yeah.
and a developed market country. And, technically, it, there's some gray area because, like, to Baafi's point, like, China kind of is more of a developed country, but it's still considered in a lot of funds more of an emerging markets type country. And the only reason why is because the broad definition of an emerging market country is it's a nation that's more developing and still transitioning and has high economic growth or GDP. And China still has, rapidly growing GDP. So it's still kind of, I'd say it's a more mature emerging markets country, but it's still much faster growing than a lot of the developed countries like the United States, like the United Kingdom, France, Germany, like more of these mature, been around for a while, developed economies that have these massive businesses they've had companies that are public for
Like
centuries now.
100 years, 130 years.
Exactly, exactly. So they're a little bit more stable. The growth is not as fast or exciting than maybe some of these other countries that are still rapidly industrializing and continuing to develop their economies. But yeah, I just wanted to quickly kind of highlight the differences. And I don't know, Bafi, do you have anything to add?
No, I think you did a great job. That makes sense because sometimes it can easily get confusing too, right? For many to kind of discern and dissect that. So, if you think about developed markets, that's like Josh said, that's like United States, Japan, UK, Canada, Germany, right? France. If you think of emerging market, China with a little asterisk, to it. India is an emerging market, Brazil, Taiwan, South Korea, Mexico. Those are kind of emerging markets. So, the emerging markets are, like Josh said, rapidly growing, typically not as mature or smaller environment locations and regions that are growing. But yeah, that's pretty much it. Yeah, I think that makes sense. Yeah.
Good stuff. Well, let's jump over to Pierce. So I know
Yeah, man.
Pierce has been involved
Yeah,
with VWO.
Pierce been in this space a lot, man. So I'm
I
excited to
love
hear what
emerging
he's talking
markets.
about. He's been cooking.
So
I
share
think
with us, Pierce, then. Like, what are you kind
yep.
of seeing, or like, what's your like? Why do you like VWO?
VWO, I mean, okay, so a VWO is great, but there's also a bunch of different funds, but they come with
Of
like
course.
higher volatility and stuff like that. Like my first introduction to emerging markets was in, I want to say probably January of 22 or 23. And I had a little, I had a buddy tell me, hey, you should throw some money in Alibaba. And I was like, all right, bet, why not? So I threw some money in Alibaba. Alibaba skyrockets. And if you look, I think I bought Alibaba at like $90 a share. And right now I think it's sitting somewhere in mid 100s. And so that was my first exposure to emerging markets. And I go, wow, this is awesome, but I don't like taking the volatility. If anyone who has listened to me on this podcast, I don't like individual stocks. I don't like taking the volatility of one individual stock, 5, 10 grand in there, whatever it is. And so I found this one fund called IMEG, and it's an iShares thing. So um, it's it's good. Emerging markets are one of those things to where if you get bored of the 2% GDP growth in the United States, it's one of those things you got to have these fundamentals set up first, right? You got to have like your whole portfolio set up, and then you can start branching out into different things, right? Like, this is not, you don't make emerging markets 50% of your
Yeah.
portfolio.
Yeah, that's
I
not the
wouldn't
core,
suggest
right?
It's
not at
it's a
all.
tilt or like a satellite
It
position.
is. It is. You're just kind of transitioning some money from here to there. And I think emerging markets, just like Baafi, everyone else has said, India and all these different things, and China too. China is an emerging market because of all of the political tension that's going on within the Chinese government right now, whatever you want to call it. And it's been like that for over the last 15, 20 years. And the emerging markets are one of those things to where there is higher volatility than I guess an annualized 2% growth. Sometimes it's 5%, which is a hell of a lot better than 2% growth, here in the United States. But it also comes with a bunch more volatility. And so VWO in itself has been fantastic. Over the last 5 years, like Josh said, these funds have not had a very good year over year return, which is okay. I mean, markets are, they go and everything goes in, ebbs and flows. And so over the last 3 years is really when everything's been kind of just going up for one reason or another. Humanity's, we're just evolving as humans. We're understanding each other in markets and stuff like that better. And all of these different governments are finally kind of getting their feet under them to kind of start walking by themselves. And like Baafi said, South Korea, honestly, if anyone listens to me, South Korea is very underrated government, area, underrated fund area, and all of these different things with emerging markets is you gotta have your nest eggs is what I'm saying. You gotta have everything in your basket first, and then you start transitioning yourself. Like
You,
I've been in IMEG for a while, and I also do have some exposure to VWO. And so there's different core fundamentals. Like, there's the big four is China, Taiwan, India, and South Korea. And so like the rest of the world makes up for like 28% of it. Like, we're talking Brazil, Saudi Arabia, and all these other, smaller scale countries. But there's these big players in the countries, and these funds that make up for most of it. So you got to watch those markets first. I can go on and on about funds. That VWO is fantastic.
Man, and
um,
I think the beautiful thing too is like this is why investing is fun, right? Because there's so many new and different things you could learn. I mean, how many of us woke up in 2023, 2024, 2025 like, hey, maybe I should look at learning a little bit about the Japanese market, the Korean market, right? Like, no,
Yeah.
we're just in the West, we don't think about the East. You know what I mean? It's like, but this is a huge opportunity here for everybody listening to learn something new or add another piece to your already built skill set, right? So the VWO that Pierce is talking about, for those that may not be familiar with it, it has 5,034 stocks in it,
Yeah.
in that
Bunch.
fund, right? So in terms of capturing the entire basket, you have everything worth having in this thing here. If you're somebody who's excited about ex-US and just excited about getting exposure outside the US, but you don't really know how to start or a starting point, or like how do I assess these different regions in the markets in a healthy way? How do I do the research on them, and like what companies are even there, right? Of course, you could do your
Yeah.
own research for sure, but this is like a shortcut way of benefiting from all of that without the headache, especially if you don't have the time, right? And I mean, technology is 25%, financial services 20, and when you kind of break it down even further, the top 10 holdings in terms of individual stocks, Taiwan Semiconductor holds the most weight at 11, Tencent
Yep.
Holdings, right? That's Asia. Alibaba, Pierce was just talking about
Shout
that,
out Baba.
right? HDFC Bank, Reliance Industrials, China Construction, Hon High Precision, right? MediaTek. So there's a lot of companies there that some of us never even seen or heard of,
mhm.
and like right now it's easy for us to look at Nvidia or Microsoft or Google or Amazon and be like, oh yeah, well, maybe these are easy to invest in, right? Because we've been around it 24/7. But a lot of these emerging market companies, we don't even know their name. Many of us have no idea, right? We don't know their name, we don't know the history, we don't know how those markets operate. And it's not like you can just go in there and just learn everything overnight. It takes time, and as that time is passing, the markets are growing. And so, to me, the way I look at it is like, VWO is a great intro to it. You kind of,
It
get the
is.
benefit of it while you're learning at the same time. And then you can kind of branch off a little bit more into things within that space that you find interesting and you're excited about.
I'm going to quickly break down some of the top countries in VWO from the Vanguard's fact sheet itself, just so people can get a feel for what type of countries you're actually getting exposed to when you buy something like VWO. For context, there are so many different countries that you could technically invest in individually. There's literally an index fund for almost every country out there if you want to invest individually. It's like there's a index fund to invest in Chinese, like just specifically the Chinese stock markets. There's index funds to invest specifically in the Japanese stock markets. So you can find an index fund on almost any country's specific stock market if you wanted to concentrate in that one market alone. Now, the good news with something like VWO is you're getting exposed to some of the better emerging market countries that are actually posting results. And they're more of the stable, like more of the stable emerging market countries. Because again, to what we mentioned earlier, a lot of these countries are more volatile the stock markets, although their stock markets are in rapidly growing countries, with rapid growth comes rapid corrections and more volatility. And so something like VWO gives you more, wider exposure to more of the, you know, safer, if you will, quote unquote, countries. And so the quick breakdown based on Vanguard's fact sheet is 32% of that fund is focused on China, 22% is focused on Taiwan, 19% is focused on India, and then we got 4% in South Africa, 4% in Brazil, and then 3% in Saudi Arabia. And then the rest is just kind of spread out to all the other countries that are in that fund that are emerging market related. Now, the cool thing with something like VWO is that in a way you're kind of buying that emerging market strategy, because if there's a country that starts to do better, when it comes to the business environment growing than maybe India or South Africa, it starts to get a heavier weighting in that fund. So the weightings kind of adjust based on which country is kind of posting more of the results with their companies. So of course, to Bafi's point, TSMC is the biggest company in that fund right now because it's the one posting the most results, right? Right now, TSMC's built some massive deals with the US where they're building facilities in Arizona to kind of diversify their business. And it's like they're a global powerhouse of a company. They're operating all around the world. And so they get that number one spot in this fund. So as you can imagine, like the better the companies continue to expand in these economies, they're going to get exposed in the VWO fund if they're continuing to rapidly develop and grow as a business with their economy. And TSMC operates in Taiwan, which is a country that has experienced massive growth, over the last couple of decades. So pretty interesting stuff. And I think it just goes to show, to Pierce's point earlier, is like you don't want to make something as volatile like this as your core holding. I mean, ideally you don't, unless you have like specific knowledge in the emerging markets and you're an expert, then that's a different story. But for most people, what they typically do with emerging markets funds is they add them as like a tilt. It's like maybe they'd have something a little bit more stable, kind of like more of a developed market fund like the S&P 500, which it's a little bit more boring than the exciting emerging markets, but nonetheless, it's in a more mature business environment and growth environment, if you will, or even like a total world market fund
Yeah.
where you get a little bit of everything, and you're getting exposure to Europe, to Asia, like more of the developed parts, and the businesses that are actually posting results. And so, if you do have the curiosity to add a spice of emerging markets, VWO is a common fund that a lot of investors use to kind of add that tilt to their portfolio.
Yeah, no, I agree. And I think it's also important to recognize that yes, as much as there's a lot of inflows going into these spaces, right, and investments going in there, and a lot of opportunity and growth is there, you have to understand the higher the risk or the higher the growth, typically the bigger the risk, right? And you know, the emerging market is going to do fine, is going to do well, but you have to understand it's not going to be, and these regions are not going to be able to absorb certain shocks in the same manner that, let's say your US market will be able to absorb or shake off, right? Certain things really hit these emerging markets like heavy as well. Don't get me wrong. So just keep the balance of risk and excitement in mind, but don't be overly biased to the excitement because it's exciting and there's a lot of growth, a lot of potential, and you forget to put the actual skepticism lens on as you do more homework, more research on these environments. You got to think about it. Some of these areas, they might be in an election year coming up, a year or two. That's all very important in how you're going to make your decisions in those markets, or if you're looking at specific stocks in those countries, right? So there's a lot of things to consider where in the US market, there's really not a whole lot to consider. It's really just tariffs for the most part, AI and data center infrastructure build out spend by a lot of these companies and what disruption that's going to do. And then rates, right? Rates been coming down, unemployment a bit sticky, inflation is still a little bit sticky, but it's very much under control and manageable. And then I guess another thing to keep in mind from a US perspective is really we're changing feds, right? In the near future. So that's pretty much it. But in emerging markets, you got to keep like 20 things in mind because you got to not only do you need to keep all the stuff in the US in mind for those emerging market regions and stuff, you got to keep their own local stuff and their own regional stuff in mind too. So that can be a lot of information to absorb in a quick, short time period if you already don't have that foundational space in those markets or comfortable in those spaces already. So just keep that in mind. Yeah.
Yeah, another thing that kind of going on with what Baafi said is that I like how you put it, they can't absorb the shocks the United States can. And that's the thing is that I don't what happens directly in the United States does trickle off to the rest of the world. And so that's one of the things with these funds that, we could have something huge happen in the United States and then, it's going to hit the rest of the world just like that. So it's one of those things that you have to take into consideration when understanding your diversification strategies. Like, hey, is this really what I want to do? And so whether it's, VWO or, any of these other funds, IMEG or IEM and whatever it is, all these other different funds, you have to understand that the United States is kind of the big powerhouse of this, and we kind of control it because most of these countries use United States money.
That's a good point. And the way I kind of think of it is, I think a lot of investors, one of the first things they learn is that a lot of these larger companies in the US tend to be at a bigger advantage than some of the smaller companies, right? Like they have more resources, they have better talent, like they have some of the smartest people working for them with these
Yeah.
big companies
Bigger
like
balance
Nvidia,
sheets, a lot more
bigger balance
profitable,
sheets.
right?
So they can withstand some of the economic shocks a lot better because they have more resources and just more. Yeah, they have a track record of knowing how to deal with different types of crisis and whatnot. And I would say in a way it's somewhat similar, like not exactly similar, but it's somewhat similar with like developed country economies and emerging market economies because the developed economies, they tend to have people, highly skilled sort of professions and whatnot, more of a diversified economy. Like maybe they're, less focused on one sector or one certain industry that's kind of running everything. They're a little bit more diversified, so they can tend to handle some of those global shocks, those global economic shocks better. And of course, there's always exceptions. Like there has been periods where emerging markets have done better over a couple of years than the US. I mean, example, like the last 2 years, emerging markets have done really well compared to the US.
Yeah.
So it's not a perfect, if X happens, Y is not going to happen. But it's good to know from like a long-term perspective, what you're kind of getting into. And that's why I personally think of something like VWO as an aggressive kind of growth strategy. Although maybe over the last 10 years, it hasn't seen a whole lot of growth. Uh, just because you implement a growth strategy doesn't always mean you're going to see the growth, right? I mean, I think
Facts.
people have gotten that confused with tech stocks. It's like,
Yeah.
I think we all kind of know that tech stocks are a growth strategy, and it's a growth strategy that's played out. And I mean, I still think, with AI and innovation, like it's a good, I personally like the tech strategy, but at the same time, I know that it's still a higher risk, and there is a chance to where there could be a 5-year period where it underperforms something as simple as like the S&P 500 or even more broadly, like a total world market fund.
Yeah, and I'll add to that in terms of if you're gonna look at these EM spaces, right, emerging market spaces, of course, be excited about the potential, right? And that's important. That's good. But again, you're gonna want to make sure you're doing a lot of you're gonna have to do more in-depth analysis and research, right? So you're gonna do a lot more fundamental analysis because you need to understand these companies' financials, right? You need to, of course, understand, let's say, the country, the region, the economic structure, what their policies are set up is like, right? How does the rates influence their decision making? And then you got to dive in deeper and understand the businesses or the sectors and the business you want to invest in, and then understand that business financials all the way. Because there's a lot more risk and more volatility on that side, right? For example, in the US, we have the Max 7, and they're looking at 2026 wise, they're projecting to spend close to $700 billion of capital just on this AI infrastructure build out and then the next layer of that cake, right? They have the capability to spend all that money and hopefully it pans out and everything goes well. But even if it doesn't, they can absorb these shocks, right? Like where else you're gonna go find $700 billion from 7 companies to invest in something outside the U.S.? You're just not. You're just not gonna be able to do that. So you have to understand that the U.S. market is very unique and is in a privileged and a special position within global economy, global investments, because the system and the policies allows for more business, less friction, more advancement, more competition, more innovation, and is one of the very few countries globally that they can burn that much cash. I mean, think about it. Even when companies go IPO for the first time, they're not profitable. They're literally not making any profit for like 5 to 10 years, and they are burning billions of dollars. It's almost like they're just flushing it down the toilet, right? But they're investing in the business. You look at OpenAI. We all use ChatGPT now, so I know this is going to resonate well. To this day, they still don't make no money. They're burning billions and billions. They burned probably $200 billion. When Amazon first came on, before they even became profitable, they had burned close to 700 or eight, like they had burned so much money before they became profitable. But look at where Amazon is at today, right? So make sure that you do your research, not just on the economy and the business and what they do and the trend that we see, but understand the financials and the balance sheets of these companies that you're looking at or interested in. That's going to be huge, right? It's going to come down to valuation and quality businesses that you invest in. Shortcut, VWO. Then you don't got to do anything. You could take the lazy way out.
Good point, Baafi. And that's important. It's important to say because I think it's easy to forget the business environment. And in reality, as investors, we want to invest our money in places where we get ideally a return, right? We want at least a return. And then, of course, the higher the return, the better. But to Baafi's point, not every country or market is equal. And so like it's easy to think like, oh, maybe it's smart to just diversify to, different economies. Like maybe I should add some exposure to like Brazil or India, they're up and coming. But it's like just because they're, an emerging markets country, although they might have a good tailwind, I'm not saying that you shouldn't invest in them, but there's just risks that you got to be involved or you got to be aware of as an investor just to know what you're getting into. And for example, I want to go over kind of the top three stock markets in the world right now. Right now, the US has around $71 trillion worth of cash uh, invested in the stock market. That's currently the market value of all stocks in the US stock market is around $71 trillion. The second, number two, that's the second country uh, with the biggest stock markets. I've already touched on this. It's China, but the margin of difference is insane. So like US is number one at 71 trillion. China is the second biggest stock market at 11 trillion. So it's a fraction of the amount of capital that's kind of involved in those economies. Of course, again, China is kind of like that. It's technically emerging market. It's still rapidly growing, and there is uh, thoughts out there that China can eventually replace the U.S. stock market in one day. It's very possible. I mean, they have a huge country, a huge population,
Yeah,
but
just
of
not
course, like there's
today.
still exactly not today, and there's still risks, right? There's political risk. It's like the U.S. is one of the most business friendly places in the world. Um, you know, I think everybody's aware that the U.S. is very profit driven. That's one thing that's kind of in its blood, and
Yeah.
that's just by design. And so, like as an investor, you got to keep that in mind. It's like although China is something that's kind of rapidly growing, it's like as long as you're aware of the risks, not every country is kind of developed equally when it comes to their business environments and their growth potential from a return on investment from the investor's perspective. And so like, that's something you want to keep in mind. A lot of these smaller countries, they have more political risk than the US. Like, of course, the US is not perfect when it comes to politics. We all know that. But in the business environment itself, it's in kind of a league of its own.
Yeah,
So
it definitely is. And I think and to same thing you just said, to put a slight different angle on it is even the countries outside of US have most of the investments in the US. Like literally they invest in the US stock market, in our equity markets, in our businesses. Why? Because we have the largest and most liquid capital markets in the world. There's just nobody comes even close to that, right? Like as you just heard Josh mention, just the gap from first, US being first to second, China alone is massive, right? You talk about the world's biggest companies, they sit right here. Out of the top 10 companies in the world by market cap, I believe it's probably like a good eight of them is easily US companies. Of course, Saudi Aramco, because of the oil, is heavy, so that kicks up pretty nicely for them, right? So that is huge. You talk about legal protections and regulatory transparency, right? There's less friction. We can do business here a lot easier. You can get capital a lot more. You can raise capital quicker. The policies is more favored. It's not state owned per se, which is very much different to what China's is, and is considered like a safe haven for global uncertainty, right? So if you look at it from a credit perspective, from a treasury perspective, from a business perspective, from growth perspective, these other companies put their money here as well because they want the best returns as well. You know what I mean? So, Brazil is not gonna put all their money in Brazil because they'll get some growth, but they're not going to get the the broader exposure to most of the growth that's happening, right? They'll put a decent amount in the US. Of course, they invest back in their country because that's important. But they want to make sure they're getting the growth and gains that the US gets. So as US grows, US economy continues growing, and the US stock market grows, the whole world stock market grows. When your 401k grows, US market is growing, international markets are growing as well. So everybody, right? All the what is it? What's the saying? The tide,
Rising
rising
tide.
tide lifts all boats. Yeah,
Yep.
yeah. Just make sure you have a boat. That's the most important thing.
Yeah, get that vote for sure. And it's also good, like to play this point that a lot of these S&P 500 companies, they operate all around the world. So I think people forget that where you kind of get it's easy to get tunnel vision. It's like, oh, I'm 100% in the US, like all my investments are in the US stock market. Like what if something happens to their economy? And of course that's a real risk, right? But at the same time, it's like a lot of these companies, like think Apple, Google, Microsoft, even like they don't only operate in the US. Like they're operating all around the world. And just like some of these other international companies, like TSMC, for example, like they're also operating all around the world, not just in Taiwan. They recently opened up some fabs in Arizona. It's like they're operating in the US. And it's like a lot of the global economy is more interconnected than I think people understand. Of course, in the last couple of years, there's been a little bit of tension between the countries with everything going on. But I just think it's important to kind of put things into context because it's easy to kind of, especially when it comes to diversification, to go down the rabbit hole. It's like, oh, if I'm only in U.S. stocks, then am I, overly risky, or, you know, should I add, every country into my portfolio? Should I have some Brazil, India? Do I have to go out there and pick every single country and add it in? It's like you don't necessarily have to do that. Keep things simple. It's easy to overcomplicate what doesn't need to be overcomplicated, especially when it comes to your portfolio. To Baafi's earlier points, these hedge funds, these fund managers, they're the ones that have the edge of like knowing where things are going to go when it comes to before the public is aware of what information's out there. And it's like you don't need to sit there and try to predict what's going to happen. You can simply play the ownership game. Buy quality assets such as these index funds that give you broader exposure. If you want to add a tilt towards emerging markets just to add, a growth aspect to your portfolio for whatever reason, there's nothing wrong with that. Just be smart with how you're kind of doing it. To Baafi's point as well, you don't want to just add something without knowing what you're getting involved with. And hopefully with this episode, it's helped kind of explain some of the nuances. And of course, I don't want people, I know we have like an international audience. Like I don't want them to think we're naive and assuming that the US, will always be number one. Like, of course, maybe not in, 50 years from now. It's like everything, things can change and they could shift. But nonetheless, it's like we want to observe where things are at now and position ourselves to just be smart with how we're long story short, be smart with how you're positioning yourself. Like don't let your imagination get ahead of like where you things might go. Because that tends to be where people get into trouble is when they try to front run everything and then maybe they build this story of what they think is going to happen and then maybe it doesn't happen and then you're kind of left holding something you don't want to hold anymore. So
Yeah.
be smart with how you position, especially your core. If you want to add tilts to the areas that you want to lean into because of your research and what you understand risk wise and your risk tolerance, like go for it, but just be smart about it. But we covered a lot here. This episode was pretty lengthy, and hopefully it helps uncover a little bit of the mystery around emerging markets. Uh, Before we officially wrap up, is there anything Baafi? Do you have any last comments for the audience to chew on as they consider emerging markets?
Absolutely, man. And this is not even just for emerging markets alone, but it definitely has an influence there. Um, there's a lot of uncertainty, a lot of fear, a lot of like, okay, what is the world coming to, right? There's just a whole lot of um, negative reality also that exists, right? It's like some of these things are really having an impact on lives and nations and countries and regions. Um, and so it's easy to kind of not be optimistic or not feel like the world can get better or the world will get better because, daily we're all reminded of a ton of negative things happening, right? Whether it's with unemployment, whether it's AI coming to take all our jobs and, layoffs are happening and layoffs happen for a myriad of reasons, so many reasons, right? One of the reasons that nobody really think about when it comes to layoffs is, with the tariff situation, right? Like companies don't know how much or how they can actually move until they kind of see how that plays out, so that makes the job market a little bit tougher, hiring a little bit tougher as well. So the main thing I want to drive at with the parting message to finish off is, look, in the future is not much different from the past in the sense of there's a lot of good things that are going to happen, and there's also going to be, unfortunately, some difficult things that do happen, and that has been much more the same forever. The only thing is just the years change, the people on the planet change, right? The tools and resources and advancement and stuff like that takes place, but fundamentally that has kind of been what life has always been, right? And so the Russia war, that will end at some point, hopefully in the near future, because we don't want to see lives lost, and that does have negative impact on a lot of things, right? Tariffs, hopefully that subside, and we saw some of the ruling recently this week. Let's see how things progress, and the more that gets sorted out and get finalized, the better everybody can resume more economic activity, right? Inflation is well in check and things looks pretty good, much better. Gas is not costing us an arm and a leg, and eggs are not $8 anymore. So you can eat all the eggs you want. And then rates are coming down still, right? There's still a good chance that there's probably going to be at least one more cut in the US. And in other nations, things are pretty steady and healthy, right? AI productivity gains, you won't really see that manifest fully in businesses until a couple of years from now. That's when it will start to kind of really become more profitable because it's still building out. But I say all that to say that, look, some of these things are going to help and shift things forward. And no matter what's happening, you want to make sure that you are giving yourself a fighting chance. You want to make sure that you are investing, that you are having a healthy balance with your money, that you're controlling the controllables, and you're benefiting from your hard work and your constant education in yourself by listening to this podcast, by following the page, right? By constantly asking questions and doing research. You want to benefit from that. You don't want to be in a position where it's just about pointing fingers, right? And you're not gaining nothing out of it, because at the end of the day, unless these companies and these nations are your dad or your moms that own it and run it, it's going to be very difficult for you to just impart your will, or ensure that what you think is right is getting done, because at the end of the day, shareholders and investors are the top priority for these businesses, and providing value not just to that but to the public at large, whether it's services or goods. Those are always going to be the top priority, and unfortunately, sometimes the employees are going to become collateral damage as these businesses navigate new, new environment, new world, new competition, new tools and systems. You don't want to be, it's a world where you have to think in duality, right? And you don't have to like everything that's happening, but you need to understand and know that everything can coexist. Even the stuff we don't want to exist can't coexist, and make sure that you're doing your part in making sure that you're protecting yourself, your family, and your future. Because whether we like some of these things or not, they're going to happen. Some are going to continue happening, and some won't. But the most important thing is to make sure that you are doing your part in controlling what you can control. And part of that is making sure that while you have a job, while you're able to walk, while you're capable, take advantage of everything that's being shared here and everything that you have access to. Don't wait till it's too late. Don't wait till it's last minute or something like that. And then you get set back, decades, and then your family's struggling. That's part of the reason why we do this work here on this podcast, is because we want everybody to win, and there's enough to go around. So make sure you get your pie.
Hmm.
Long-winded way of giving a short message, but there you have it.
Go get your share of ownership. That's what it is. And Mafia, I love it, man. And it is easy to get lost in the noise and kind of throw in the towel and think that there's no hope and that you can't win. But the good news is there are simple strategies that you can implement. And if you go into the stock market with an ownership mindset, not not thinking of the stock market like a casino and trying to buy the right lottery ticket. If you go in thinking with an ownership mindset and you go in and transition your job income into asset income by buying quality stocks, you're going to do a lot better than if you ignored investing and just hope something magically fixes itself. Because the best part is, like, the more you continue to buy asset income and transition your job income into asset income, the less you actually have to depend on your job, right? Like that's what this is all about. It's about giving you more options and ultimately more control over how you can kind of maneuver through the world. Because if one thing's certain, I already highlighted that the US has around $71 trillion of a market cap within all these companies. So there's a lot of money in these companies. And so like if you're not going to buy them, somebody else is going to buy them. And so at the very least, like just take advantage of the stock market. It's never been easier to get started. You can start with as little as $5. Like there's really no excuse to get started. And the best part is like, although it might seem like an uphill battle in the beginning, and in a way it kind of is, the more you stay consistent with it and you continue to build that habit of investing, whether it is, at the beginning, like $20 a week or whatever it is, like the easier it's going to get to invest more, when your income ideally increases, as well as benefiting from this thing called compound interest, which is one of the most powerful growth forces in the stock markets. So, don't let all of the noise and including all the options available to you confuse you or make you stall on making investing habits. This episode specifically, we touched on emerging markets, and I'm sure it kind of unlocked different routes you could explore. And you can probably imagine how easy it is to kind of get lost in all the details, which is why I wanted to end with something like VWO, because it's kind of the simpler way to have a tilt towards emerging markets without turning the stock market into your part-time job and trying to predict which economy is going to outperform in 2027 and 2028. Baafi's already shared that even the best people, with the biggest, the best resources and the biggest capital bags, if you will, like even they, like, of course, there's some that do outperform, but a lot of them still struggle to find the next, hot stock or the next hot sector. And even if they do, by the time you're aware of it, it's going to be kind of too late. It's going to be, by the time it's in the public attention and, by the time you're seeing it on CNBC, it's likely too late. So keep things simple. You don't got to overcomplicate, this investing thing. And most importantly, the simpler you keep it, the more you can actually focus on your own life, focus on your own career and grow your income with your career, which is really what matters, as well as focusing, with the people you love, focusing your time with your family, your loved ones. That's what really matters. Don't turn the stock market into another part-time job unless you're getting a salary from it. But cool stuff. So Pierce, any last thoughts before we officially wrap up this podcast on your end?
Not too much, man. Just do your research on emerging markets, make sure you have your nest eggs in there and your core foundation, and then start having fun.
Awesome stuff, man. Awesome stuff. Yeah, we don't want to forget the foundation. It's the most important parts. Once you got your core built, once you got that emergency fund set up, I know it sounds boring, but it's the most crucial part, especially in today's world where the job market is shifting. There's a lot of uncertainty with the technology. The last thing you want to do is have no, wiggle room when it comes to your emergency fund. In the case that you have to adapt, so build that. Then you can, of course, build your core foundation of your portfolio and something a little bit more stable, something more dependable when it comes to long-term growth, like a total world market fund, if you want exposure to a little bit of everything, or even something as simple as the S&P 500, giving you exposure to those top 500 companies. And then, of course, you can always experiment down the road, whether it is adding a tilt towards emerging markets or a tilt towards whatever you've researched and understand and can accept the risk. That's a wrap for episode 71. This was a fun one. Do me a quick favor. If you found this episode helpful, leave us a quick 5-star review on whatever podcast platform you are listening in on, and maybe also share the episode with somebody that you think would find it helpful. Baafi and Pierce, thank you for coming on. It's always nice to kind of hear your guys' perspective, kind of bringing some new energy to the podcast. And Market Hustle community, we'll catch you back on the next episode. Thank you so much for coming on. Have a great rest of your night, and bye-bye.